Good afternoon, everyone. It's Switzerland, therefore it's 2 o'clock. We try to start on time. We only have 40 minutes for a topic which is huge and widespread. It's EM debt and China fixed income in the current environment. Emerging market debt has become more or less an important part of an asset allocation, also for investors here in Europe or Switzerland specific, given also the environment of low yields, which we have seen in the last couple of years. Now, we had quite some challenges last year, the COVID crisis, with still on certain parts that are going on in certain segments. But we also have new other opportunities or headwinds at the moment for this asset class. I've just looked up the major indices on the sub-asset areas, and they're all down in US dollar between 10 and 15% year to date. So, said that positively, there's a lot of opportunity to go back, hopefully. I'll do a short introduction on who's on the panel. I have directly from Hong Kong, Gigi. Gigi is portfolio manager at Invesco. Hello, Gigi. And she looks after Asian debt products on the whole spectrum, but really Asia, where China, of course, is a main focus. Then next to me is Damien Buget. Damien Buget is Chief Investment Officer of Finistra Capital, which is part of Principal Global Investors. He's also in the EM debt space for many years, and what he looks after is specifically on a total return approach, much more than on the benchmark measured. Then next to Damien, I'll welcome Matt Morgan. Matt Morgan is an investment director at Jupiter Asset Management, where he oversees and looks after different portfolios. One of it is their EM debt strategies, which is a special focus on corporate EM debt. And then last but not least is Polina Kurdyavko. Sorry, I'm so bad in that language. I have to apologize. Polina, she is also very senior in the area of emerging market debt. And she has the insights not only on total return, but also absolute return with short abilities, but also more in the traditional area, which are managed towards specific benchmarks, as well across all sub-asset classes. So that's for a quick introduction from my side. So I have mentioned a little bit that we have a lot of headwinds, unfortunately, at the moment. Let's start with one important topic, which is inflation, and with the inflation, interest rates rising or anticipated interest rising. What does that mean for your positioning and for the portfolio in EM debt? Maybe Damien, if you would want to shoot ahead.
Well, I mean, it's true that inflation has become mainstream very much since September, October last year, when this inflation scare truly became global. But I would argue that this inflation issue started much earlier in emerging markets. So as early as the first half of last year, we saw the initial commodity shock to which most emerging market central banks started to react very early on. And they've continued to react to the point that, what I would argue for is that we're very close to the end of the tightening cycle in most emerging countries. Of course, there are regional differences. Latin America being certainly much more advanced, Eastern Europe already being quite advanced, but with residual inflationary pressures, and Asia lagging in terms of reaction function. The nature of inflation in EM is mostly commodity-led. So the kind of labor market disruptions, supply chain issues, or logistical issues is far less present in our space than for developed markets. So as such, I would argue that, and that's been our conviction since the beginning of the year. Of course, the timing has been probably postponed by this Russian invasion of Ukraine in terms of an extra leg higher in a number of commodities. But we're still convinced that the peak in EM inflation is looming, and that EM central banks, and that's quite unique in this cycle, have largely front-run the Fed and the ECB. So that risk premia have already been rebuilt, which puts us into a unique position to address the upcoming challenges, which are still lingering, arguably, in developed countries.
Polina, what's your view on that?
I think that when we think about implication of inflation and high rates, there are probably three factors to keep in mind. The first one is that 2/3 of emerging market countries are commodity exporters, and hence, when it comes to their current account dynamic, and to some degree when it comes to their fiscal dynamic, they're actually benefiting from the high commodity prices in the high inflation environment. The second is what implication on further rate hikes we would see from the total return of the asset class. If you look at the forward curve today, even though we're pricing in the US a number of rate hikes taking the Fed rates to over 3% sometime in mid of 2023, the forward expectations for 10-year actually are close to where it is at the moment. And why it matters is that if you have a long duration asset class and you're focusing on total return, you need to understand where you're going to have your core rates. Now, as the market implies today, even with inflation expectations being elevated, it implies that the long end of the curve priced in most of that correction. And the third point is implications on default. If you look at the high yield segment of emerging market debt, the segment that has repriced the most is hard currency debt, which today on an index level gives you over 10% yield in dollars. That implies double-digit default rate over the next 12 months in emerging market sovereign. If I look at all the countries in the emerging market debt index that trade at mid-80s or below, i.e. that price some probability of default, the total adds up to 5% in the index. So we feel that those default expectations are already elevated. And therefore, I would conclude that there's no doubt risk assets do not perform well in the second half of the rate rising cycle, especially if it's accompanied by fears of recession. And that applies to all risk assets. However, within the group of risk assets, the three reasons that I outlined actually makes emerging markets on a relative basis not a bad place to be, and the place which in certain segments has repriced the most.
Thank you, Polina. We have clearly seen that inflation is a problematic situation as lined out in the US, and the US interest rate goes up. European has a problem as well. And Damien already said that some emerging market countries are a little bit ahead of the curve and not behind of the curve. Maybe Gigi, you can tell us how that looks in China. I think also it's quite a different stance at the moment as on monetary policy compared to the US. What's your thoughts on that one?
Yeah, sure. So I had to laugh when Polina and Damien mentioned about the EM. Firstly, you mentioned the central banks are ahead of the curve this time versus the Fed. I really have to say China is on a different cycle, and the whole Asia central banks are actually lagging. So secondly, in terms of the commodity exporting, right? And actually Asia is the region with the most commodity importing countries. So we are also on the unfavorable end. And the third one is the default rate, basically. And I totally agree this year default rate is actually not as bad in EM as we might think in the recession period or inflation, spiking period. But obviously we have the China property. So our default rate is much higher than the other sub-regions within the global emerging market. And coming back, people have a lot of questions about China, about Asia this year in terms of the monetary policy and also the fiscal policy. I think it's very important to mention that China this year might stay on a different side versus the major central banks in the whole world. So China is on an easing cycle. And also we know the inflation in China is not as high as in the major economies in the world. So basically US and Europe and even other major emerging market countries. And the other side, which gives China actually a lot of buffer to do the easing. And secondly, Chinese government wants to boost the economy, as we know that the COVID situation in China right now is basically surging. The COVID number is spiking, and several cities is basically facing lockdowns.
Can you just give me 2-3 hints why inflation is less of a problem in China right now, given the fact that you said commodity is a commodity importer, it's not an exporter where others are supported, and commodity prices have surged tremendously. So why is that less of a problem than it is in the more Western world?
In China, people look at CPI. So CPI is a major indicator to follow the inflation pressure versus the other major economies. And obviously, current CPI is still below 2%. So I think the major target or threshold people are looking at is a 3%. So as long as the CPI is way below 3%, the Chinese government actually still has much more room to increase, so basically to reduce the rates, basically to do more easing. And the inflation pressure versus, let's say, in the US right now, 8%, we're definitely in a different world and different cycle.
Tom, can I add
And
a question
obviously-
to Gigi on that? If I may.
Yes, you can add, but I also want to bring along Matt, and afterwards he couldn't say a word yet, but please, Polina, go ahead.
Just to follow on that question, I think it's a point well made. However, that is what we're facing today. If we think about the rest of the year, the question is whether the inflation pressures in China will start rising. That hasn't happened to date. And the fact, and I'd be very keen to hear Gigi's view on that, because from what we've seen, a full lockdown of a city reduces freight supply by 54%. If that is the phenomena that we're starting to see, which could put more pressure on supply disruption and further pressure on commodity prices, does that in itself put more pressure on inflation going forward, which then perhaps could change the monetary policy to be less accommodative, if you're implying that that's likely to stay loose for the rest of the year?
So
I really
Gigi,
like
back
the
to you.
question,
So
Polina.
sorry, Matt, you will have your 20 seconds. Don't worry. Go ahead.
I really like the question. So this is a really good question. I do think the inflation pressure would increase. Also depending like how the commodity prices really stays in the second half of this year. But obviously, Chinese economy is different versus the other major economies, rather relatively controlled economy. And I do, let's say, put it this way, like I'm much more comfortable to have more doubt to see how the inflation will really be passed through on the consumer end. And basically the effect of the spike in commodity prices will have a big impact on the inflation front in China. And also depending on the timing, let's say if we see the sign of the inflation picking up end of this year, but before that, the major easing policy actually take place and also actually shows the effect. And maybe we're going to see like the positive effect of the economic improvement and then the inflation, so which actually gives the government a lot more flexibility to do the easing, maybe in the next, let's say, 2 quarters, but maybe not to the end of this year. And I think that's also very tricky. It really depends also on the COVID situation right now in China. Obviously, people say Shanghai suffered a lot in the past few weeks. And but I think the major other cities actually learned from Shanghai by doing a much better coordination and also to do a much quicker, let's say, the mass testing in the cities. We see right now in Beijing, and China has started doing the mass testing for 22 million people, just with the 33 confirmed cases yesterday. And besides that, and I do not believe Beijing is going to have a full lockdown as Shanghai. And obviously, we have seen Shenzhen and Guangzhou, also the major cities with major trading activities and economic activities, didn't have a lockdown, and they actually has managed the situation quite well. The COVID, measurement has quite contained. I think, I personally, obviously, this is the fluid situation. I think China GDP economic development will suffer definitely in the second quarter, but going on maybe in the second half of next year, and also with more easing measures coming out, and the economic activities will be, I'm not saying back to normal, but will definitely recover much more than this first half.
Okay, thank you. It seems like good news that hopefully we have less lockdowns or even better managed lockdowns. I mean, Matt, we heard inflation. Of course, it's led a lot by commodities. So you have a focus on corporates, as I understand. What does that mean, this combination of inflation and also that the commodity prices and energy prices, of course, are two major drivers of inflation? What does that mean on your view?
Yeah, thanks. I mean, I guess, firstly, I would agree with pretty much everything said so far. I think the thing that we have been banging the drum for emerging market corporate credit for a long time, very much part of the asset class, but very many of global investors still think of EM and they think of sovereigns. They think of that, ENBI, as we call it, global sovereign benchmark. Corporates are still underlooked. They're still under-owned, still under-invested in. And we think that there are significant benefits to corporates, not just because you get from the few areas in global fixed income where you still get a spread premium relative to the same risk for investing in similar assets. And one of the things that's really interesting right now about that corporate world is it gives you diversification. So, for example, I totally agree with my comments of my colleagues on, what you're looking for right now is how do you deal with inflation? Firstly, you look for companies that can pass through that inflation. So we've done a lot of work on thinking what corporates can pass through that inflation onto consumers. Been buying things like utility companies which can pass through some of that inflation and also, can sort of benefit from it, plus can deal with have more dollar exposure and can deal with the strengthening dollar we've seen. On the commodity side, of course, as Polina said, there's plenty you can do, whether in Brazil, Nigeria, etc., to try and get commodity exposure in EM, and that's been very beneficial. And the final thing I would say, that central bank tightening, as Damien said, EM central banks have moved a long way, particularly in places like LATAM. We've had 156, if that number is still right, it changes every day, rate hikes globally since February last year. And I think the US has done one. So the first one was in Zambia, for interest. So most of them have been EM. Places like Brazil, we've had a lot of rate hikes, and as Damien said, we think that we're getting towards the end of that rate hiking cycle. And that just means when you look at some of the companies out there, the local economy in Brazil, we think rate hiking's done, inflation is starting to subside. And we see lots of interesting opportunities, but definitely that central bank policy divergence is where we're looking to deliver alpha at the moment. And in the corporate space, there's lots of different opportunities to do that.
Thank you, Matt. Damien, you look much more on the total return angle on that portfolio. How do corporate look like, or those things which Matt just mentioned right now? Is that something your favorite spot, or just on average, or what's your thoughts on there?
Right. So basically, yes, approaching the market from a total return angle means we have no obligation to own any particular market segment. So at this point, I would concur with what Polina was saying. I mean, where we see the best and the most attractive source of value is really on hard currency sovereign, followed by local bonds, because in a number of those places, central banks have done a good job, risk premia have really been rebuilt. And last but not least, the levels of ownership, and I agree with you on that. I mean, we've never seen the money coming back after the COVID outflow. I mean, certainly not in similar magnitude to what we saw in hard currency credit. So, essentially, the flows that wanted to be invested in global credits after the crisis just followed the central banks in their asset purchase programs. And the same happened to local currency, where Chinese government bonds kind of acted as a magnet for flows. So as a result, the bulk of EMs was actually ignored by global financial flows in terms of, post-COVID recovery. So when it comes to corporates, we consider corporates these days as a very healthy universe from a fundamental standpoint. They've survived the COVID crisis really well. Leverage levels have remained very low. Most of them have been very astute in terms of liability management, refinancing at low yield levels. So debt structures are certainly not toxic in the corporate space. The thing is that we see slightly less value in a number of those corporate names, but for good reasons, because their fundamentals are so strong. So, on a relative basis, we prefer at the moment to allocate to, a bubble of distress stories which have already played out, or long-dated 30-year bonds of a number of sovereign curves which are already very steep, plus Latin American local bonds. These are our preferred longs at the moment.
Gigi wanted to mention something, please.
I actually have a question for Matt and Damien. That's the question which, always puzzle me. Firstly, you always look at like Asia credit and China credit versus the EM, the rest of the EM region. It used to be LATAM credit is much cheaper, versus the Asia credit. And this year, obviously, because of the Russian-Ukraine conflict, because of the commodity factor, and also because of central bank decisions, and the LATAM corporates, along with the LATAM sovereign, getting much more, outperformed the rest of the region. Obviously, besides the Middle East region. And my question is, how do you look at the valuation? Do you still think the valuation is still attractive so far? And also, another specific question for Matt, within, EM corporate and EM sovereign, obviously EM sovereign is trading wider, also with lower rating. And how do you look at that? And do you still see more attractiveness on the EM corporate side versus the sovereign? Thank you.
I guess I'll go. So I guess on the first point, you're certainly right. The areas that have outperformed in the corporate space have been Latin America and I guess to an extent the Middle East. And the underperformer has obviously been China, particularly real estate. I think those trends are still intact. For Latin America, it still has, where there is growth in the world, where the economy still looks okay, for us is still the US and US consumption, still has a lot of exposure. Second, in places like Mexico in particular, also Brazil. Secondly, political stability in LATAM has been a lot better than we have been used to in the past. Even though we have had, for example, leftist presidents elected in places like Peru, Colombia, the region has remained relatively stable. If you add in that US exposure plus commodity exposure, we still like the region. Middle East is looking increasingly difficult. Valuations have become, it's an investment grade story. Valuations to us look pretty tight. We're still invested in a few places in high yield, like Oman, for example. And then finally, the big question on everyone's mind is and I'm interested in Gigi's view here, is that China real estate story. Thanks to, as Damien said, Asia central banks are behind the curve, so there's more risk that there's tightening to come, despite China inflation being low as Gigi says. And we also have this COVID lockdown situation. So the big question is, that's meant that we've been very underweight Asia for some time. The big question is, of course, does China easing start to come through? And I think there is a possibility, as Gigi was alluding to, that over the next 6 months, you start to see this COVID situation, which we just sent our Asian analyst to China, who spent 6 weeks there over Christmas, had 3 weeks lockdown, and spent 2 weeks with companies and 1 week with his family. It was kind of a crazy trip for him. And he came out thinking, firstly, people in China are very supportive of zero COVID. I think that's maybe changing in places like Shanghai. So they think it continues. That is negative for the Chinese economy. He came out very bearish on the real estate sector's continued willingness to pay its debts. And that's why we think that things are getting so bad that easing is becoming more and more likely. So we're turning slightly more neutral on China while still being relatively negative on the rest of Asia, except India, even though there is a valuation premium. Sorry, long answer, but I got started and got carried away. Excuse me, Gigi.
And thank you, Matt. Before I travel to Damien, I would like to give the word to Polina. Also in respect that you also do absolute return, where you even have more freedom to express your opinion. Maybe you can give some lights on the question on there, please.
Absolutely. Thank you. I would start by saying that 24 years ago, I started on the corporate side, so I have a soft spot for corporates. However, one of the perks with heading the team and managing all the sleeves of the types of portfolios, I have to say that in liquid EM, the two areas where we see most opportunities and dislocation is EM high-yield sovereign, given the dislocation that I mentioned, and EM FX, which actually happen to be the only asset class globally that is flat on the year. If you take out the ruble, with ruble, it's minus 2% on the year, which still is the best performing asset class on a relative basis. So that is on the asset classes. On the Chinese real estate, I think that we have to acknowledge that, we've seen real estate crisis before in emerging markets. Mexico was the last one in 2013. And the key in a crisis for the sectors such as real estate, which doesn't have inherent goodwill, is the pace and the quality of the policy response. And I think so far, China has made a policy mistake by not acting quick enough to stabilize the sector. The first litmus test will be in the middle of this year when they will propose the first restructuring of Evergrande, which is the first defaulted company, but let's not forget, majority of the sector is now in distress. And that will determine whether the rules of engagement can be acceptable to foreign investors or not. And to me, that will be the core to understand, can you actually invest in Asian and Chinese assets going forward, regardless of which sector they're in. And then last but not least, the other opportunity that we actually like, that we think has a big dislocation and potential for double-digit unlevered returns without taking short exposure, is in EM illiquid loans. Because what we're seeing now is that you see a lot of distressed sellers in banks of their loan books, performing loan books. There are two. Is
that across all countries, or is it in certain regions?
That started in the regions where you've seen distress. So, for example, Turkey in 18, India a little bit in 15, but Turkey is a lot more pronounced. Russia, as you know, Russian banks, for example, cannot invest. Well, it's a question, can they exist rather than invest? But the ramifications of that, they have loan books of Central Eastern European utilities that they have to dispose of because they cannot have those loans. And all of a sudden, you have 2-year senior secured paper, 2 to 3 times levered at mid-teens returns for sale. And let's not forget, loans are floating rate instruments, so you don't even take the duration risk. What you need is a locked-up capital because they're illiquid. But if you have 5-year lockup or 3 to 5 year lockup, it's, in my view, much better value than looking at European private credit, for example, that has been the asset class of choice for illiquid credit over the last 12 years.
Thank you. Damien, you want to add on the China property area, specific or?
Yes, in our view, and we were like many others, we liked China property in 2020. Actually, we've had up to 4 or 5% allocated to that sector in short duration, single Bs, double Bs, up until summer last year. We exited all our positions, after the first drawdown linked to Evergrande and followed by first rebound. I think we're not ready to commit on the long run. I'll tell you, I'm a bit cynical about this, but I really echo what you said about, where we rank as creditors. The process so far doesn't encourage us to think that we're going to be respected as creditors. And, we're not well placed to know exactly what's in the books. So, cynically though, 1 month ago, we've allocated 1% of the portfolio to a basket of penny credits. So, 20, 30 cents, national champions, supposedly good quality projects, 6 to 8 names. We are closing our eyes. We try to buy at 20, 30 cents, and for now we're making money, but this is the only type of approach we would envisage to that sector for now. Just a pure trading approach, an instinctive approach, which is not meant to be long-term. Because I don't think, and that's what I would say, I don't think there is value per se. There is value on the tin in terms of, yields, but it may actually turn out to be really a value trap. So at least for now, we don't have enough elements to take a medium to long-term view on that sector.
Thank you. You wanted to add something, Gigi, or no? Then I switch topic quickly. I mean, we had this supply chain. Please, Gigi,
I
go
really
ahead.
think China property is one of the main topics I should mention and also share my view. And I agree with what the other people basically just mentioned. And a slight difference to what Polina mentioned about the pace of the Chinese policy response is lagging or it's too late. And I totally agree with that. But my take is Chinese government did it on purpose. It used to need, the government used to need the property sector basically to boost the GDP growth. And also, but since 2018, it's actually on the deleveraging trend. I mean, the GDP growth is definitely not the top priority. And we see like China government started with the SOE consolidation, with the overcapacity reduction, with the controlling of the overheat of the property sector. And also very important is, I think the foreign investors, because I used to work in Germany as well, and we really have to think what the government really think about, because government in China is the one who really sets the policy. And what's really important for Chinese economic growth in the past decades is actually the population growth. It's the demographic change. So what China did since last year, everything, crackdown of the tech sector, the gaming sector, and the shutdown of the evening classes, everything is basically to support the households to have more babies. And also, that's why Chinese government wants to control the property prices. And obviously, with the whole overcapacity issues, it's a must to do. And that's why on these trends, some of them will go default. And we will bearish as well. But I think currently, with the current valuation, it's very hard to say how the whole sector will do. It's definitely a consolidation, process. And the state champions, what just Dami mentioned, and they will survive. And if they survive, basically, and that's, I'm not talking about 5% yield pickup. That's a 30% yield pickup. So for being able to play this game, and I think credit research is the key, and cherry picking is the key. We really have to look at the individual balance sheet and the credit profile, and also the liquidity situation, and obviously the relationship with the auditors, the relation with the government. So a lot of sectors come into the play, and there are definitely space and potentials to make a good performance in the sector, and basically with a lot of extensive research.
Thank you, Gigi. I would like to change the topic a little bit to open up further than just China property. We have seen that supply chain has disruptions since COVID. We still have a lot of ships out there which cannot embark with all the goods. Then on the other hand, we have this high inflation. We have probably in the US, we have salaries increasing. That's probably another topic which in the EM, you tell me if it's differently. But there's talk about deglobalization on certain areas. So what are your thoughts on that one? Is that a danger in your view, or is that already on a normalization trend and that's not something major you have to look at? Damien, maybe you want to go
Right.
first.
I was actually at the IMF meetings last week, and I don't know, you may have heard Janet Yellen coining this word called friendshoring, which is the way she describes the new shape of globalization going forward, following this Russian invasion and the redefinition of geopolitical fault lines. So it's probably something we need to take into account in rethinking how globalization will evolve. Now, a lot has been said in the past few years about the need to reshore or bring production closer to the end customer. And that's certainly happening, even though certainly Eastern Europe is a prime destination for that. Mexico should be, although it probably is not benefiting as much because of the political economic context, but they should be a net beneficiary of that. But eventually, I guess the way we'll have to think about globalization, and it has implication in terms of how restructuring of the debt of certain countries, which will have to default in the coming years, how those restructuring processes will proceed. So essentially, this notion of friendshoring means that increasingly Western countries might be led or tempted to limit their trade and relationships to countries who share their values. And I'm still quite struck. I mean, there is this ongoing debate as to whether we should use Russian assets to pay for Ukrainian reconstruction, which is all fair from a moral standpoint, except that, and I think it's part of that thinking, a lot of, the upcoming period will be probably defined by moral imperatives rather than, pragmatic imperatives. And that's what we need to think hard about. So it's unclear what the consequences of that will be, but clearly, I mean, it's one lens that we should use to assess whether this or that country falls on the right side of the fence or not. I mean, take a country like Turkey. It's very clear that someone like Erdogan, who was very antagonistic with the European Union, with the US, has definitely toned down. So short term, it's a net positive because it means that a number of those populist governments are likely to choose their camp. And if push comes to shove, they prefer to side with the West, the IMF, and big money. But that remains to be seen.
Thank you, Damien. This even goes to moral. Matt, what do you say on the supply chain and the general issues there, or is it all normalized already?
I mean, similar. It's not normalized. We have definitely seen signs globally that some of those supply chain issues from COVID are starting to get better. I think people underestimate the fact that while it felt like COVID kind of normalized at the start of last year in the summer, that, for example, with the semiconductors, even though the Taiwan factories reopened, some of the key inputs, like places like factories in Malaysia, didn't open until November. So we're still in that pandemic shock, and it's still really very recent, and it takes a long time for a shock that we had during 2020 to normalize itself. So we still think that has some way to go. To Damien's point, I absolutely agree that there will be winners and losers, and there's a lot to play out here. What are the implications of, for example, a potential increase in trade from Russia that used to go to Europe to other parts of the world? What does that mean for supply chains? What that means for shipping, etc. So we have to see that play out, and there's a lot of uncertainty around it. It does mean there'll be winners and losers, which speaks to a selective approach. Which countries do you want to hold? Which corporates do you want to hold? And which ones do you want to avoid? And I definitely agree there'll be more defaults. However, just to finish, I would say it is easy to get carried away with the nature of a change like this. I think a lot of these supply chains will start to slowly resolve themselves. And I think a lot of the trends that existed pre-pandemic, the world hasn't completely changed. I think we are approaching, certainly in developed markets, peak inflation. I think we will start to see peaking in dollar strength. That will provide some respite for emerging markets, which, as we said earlier, have done a lot of their tightening already. And so I think that it's easy to get excited about how much the world has changed, and I totally agree there are ways that we have to adjust to that. But, let's not get carried away. I think you want to...
Polina, please.
Well, given that Damien mentioned Erdogan, I have to say that I actually met Erdogan 2 days after the Russian invasion. And he definitely didn't feel that he toned down. On the contrary, he actually felt that his leverage grew up substantially after what happened in Russia, because ultimately they are the link between a lot of different countries that don't talk to each other. And so he felt this is the time for Turkey to shine and actually be on the front foot. Now, we'll see whether his prophecy comes through or not. I still think the orthodox policy is more important than the leverage that he was debating. But I do feel that we have to separate, when we talk about globalization, the flow of commodities, which has been going around for years, and that's really where the biggest impact in Russia comes in, and flows of goods and services, which is a more, if you will, value-added element of globalization, which was at a lot more danger, in my view, before COVID because of the China-US trade tensions, which actually has come down a lot as a result of COVID and Russian invasion. And so I do feel globalization hasn't disappeared, but it is changing its format. And I would also say that even though, there won't be any easy choices for anyone. Let's be realistic. If you don't take Russian gas, you can't do renewable energy because it will take you 3 years, way too much money, and it's not reliable. You've got to switch on your coal facilities or nuclear facilities. Is that an easy ESG choice that Europe is facing? But that's the quickest choice, that they can replace 25% of Russia's supply. If you are dealing with the countries that are not on the if you will, green list. Let's face it, Turkey has been shipping goods from Iran since Iran has been on sanctions for the last 30 years, and all Iranians bank in Turkey, and US hasn't done anything about it because they understand the leverage only goes that far. So I do feel that at the end of the day, economic interests will prevail, but there won't be any easy choices for anyone to make, and we're going to see a meaningful reshaping of those supply chains.
It's unfortunately a true word. No easy choice at the moment. But to finish up with a positive note, I mean, there's a lot of positive already here. I would like that each of you just tells me the favorite spot or sub-asset class in the market, your major bet. Say it like that, your major positive bet within this wide world. You already mentioned a little bit. Let's see if you can go the same again. But maybe if you want to go ahead, Damien.
Well, I'm actually...
We're running out of time, so really...
No, I'm actually very positive on the asset class. I mean, to me, it's underpriced, it's underowned, and a number of catalysts are now falling into place. End of the EM inflation cycle, for a number of countries, it's the positive times of trade shock of higher commodity prices. And for the losers of the commodity game, they have some options to alleviate the shock, and we didn't talk about the possibility, and many countries are doing that, fiscalizing some of the inflation cost as well. So Chinese reflation is still in play, I believe, going forward post the COVID crisis. And frankly, I mean, after the moves of the last few days, I think we're getting closer to having priced a Fed that has closed the gap to the neutral rate. So it will happen over the next few months. It will continue to proceed. But in terms of market expectations and how much is priced, we're probably close to an equilibrium level here. So,
your
as I said,
major bet,
long dated,
strongest conviction,
long dated 30-year bonds in very steep sovereign curves, continuing to pay rates in Asia, which are the laggards of the inflation cycle.
Thank you, Damien. Gigi?
Well, I definitely have the home bias. I
of
think
course.
China. Well, I used to do global EM as well, but I think this year, especially in the current time period, time point, and I really favor the China credit from the investment grade as well as the high yield space, given the attractive valuation, given the Chinese easing cycle, and obviously we're expecting a huge amount of stimulus packages from the monetary policy side, but as well as from the fiscal policy side. And given how the credit stands currently, obviously sovereign, for the hard currency, sovereign is a very small space. We definitely favor the credit. And within the China local rates this year, obviously the trade has gone already quite a lot, but I think the Chinese government bonds still has some room to go. So basically, China credit.
Thank you, Gigi. Matt?
Yeah, I think I echo Damien's point about the asset class as a whole. I think the question for all of you as investors is, what's the time to start going back to fixed income? And when you feel that all the things we're worried about, such as inflation, rate hikes, etc., are in the price, then looking at EM corporate credit, you have rating on a rating adjusted basis. So if you like pound for pound, the EM credit is cheaper than it's been compared to high yield, developed market high yield, for 5 years. So there is definitely a valuation opportunity. And if you want to get specific, I think it's Brazil credit with local exposure, given the rate hiking that we've seen, and given our positive views on the economy, given commodity exposure.
Thank you very much. Polina, to finish off.
By sub-segment, the only asset class I think who can deliver you double-digit positive return from here is EM loans, if you can take a liquidity risk. By product, EM hedge funds are back, those who can deliver double-digit returns. And but within the liquid space, I think EM FX and EM sovereign hard currency, high yield credit in segments where dislocation has already happened.
Thank you very much. Thank you very much, everyone. I think we have a lot of opportunities there. From a first standpoint, it looks a challenging environment. But as we have seen, we have quite a few good bets here, and there's a lot of opportunities out there. Thanks a lot for the panel.
Thank you.
Thank you.
Thank you.